Welcome back, everyone. Michael here with Offshore Citizen. I'm going to try to do something fairly challenging today, which is I have various different staff who I train to perform various functions, etc. And sometimes it's pretty simple, it's administrative tasks, etc., and they can kind of learn themselves. And then other times there's sort of deep subject matter knowledge that you've accumulated over years of being immersed in something. And so it was one of those things that I was attempting to train someone on recently. And this was to do with investing. And I figured it's actually fairly difficult to communicate to somebody who doesn't have a background in investing how to invest well. And so I'm going to attempt to do that for you here today. I'll probably do a few different videos on it because it is a big topic. It's fairly complex, etc. But I do want to encourage you and recognize there is so much value in investing versus not. Like if you just try and, let's say, just reach retirement through saving alone, you will probably never do it. If you just kind of do the math, you're like, okay, let's say you make $50,000 a year of excess cash, right? So you're managing to save $50,000 a year. And most people don't, right? But lots of people save more too, but most people don't. So $50,000 a year for 20 years is $1 million. $1 million doesn't go that far, right? Especially 20 years from now. So say you work for 40 years, well, it's $2 million. By contrast, if you were to take that same $50,000 a year and you were to invest it at 10% a year, after 20 years, it's like 10x more. It's a lot more. I have to go and look up the exact numbers. You can do a compound interest calculator on it. But it's a big thing, okay? So yeah, just will make such a difference in your future, in your life, etc., that you shouldn't sit on a lot of cash. It's generally a bad idea to sit on much cash, although probably sitting on a little bit is smart, and I'm going to talk to you about that as well. So let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notifications. Really helps us, really supports the channel. I really appreciate you doing that. Please share it with your friends if you enjoy the content. Would love to kind of build the channel and get more followers, etc. If you'd like help with international tax optimization, asset protection, forming companies, opening bank accounts, getting residencies, citizenships, investing, etc., like internationally in particular, please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or you can send a message through our websites, offshorecitizen.net and offshorecapitalist.com. All right, so let's just start with, what is the basis of investing, right? The basis of investing, clearly, or maybe not so clearly, but I think fairly clearly, if we kind of strip it down to core principles, is you are going to take money and you're going to buy something with that money in the hopes that that thing that you're buying is going to be worth more in the future than it is today. Right? That's the basic idea. And of course, anytime you do that, there's a certain amount of risk that it goes down in value. But I think it does help to think in terms of, I'm buying something and I'm going to own something different, and I hope it's going to be worth more in the future than in the present, and do that at a rate that is higher than the rate of inflation, so therefore my purchasing power is going to go up over time. Okay? Pretty simple. Now, obviously, this means most cars, for example, aren't really good investments, right? Mostly they're going to decrease in value. And so we have to think about what are things that are more likely to be worth more, and how do we pick from those things the things that are more likely to be worth more, okay? So that's our exercise. We're gonna say, okay, what do we buy? What do we buy that's more likely to be worth more? And the first thing that I'm gonna mention is that there are different types of assets, okay? So let's talk about some of the types of assets. Now, the main ones that people would look at would typically be stocks, bonds. Now, bonds are just loans. It's a fancy name for loans, okay? Real estate, commodities. This would be gold, silver, oil, soybeans, whatever, things like that, right? Possibly you could separate out stocks as public companies and private companies, right? And then you can kind of break down different categories from there. You can get into kind of more diverse asset classes like art. You could invest in some sort of intellectual property. You could do vehicles or watches or litigation finance. I've mentioned that a little bit lately, etc. The point is that each of these different things has their own profile of how they live and breathe and behave, okay? So, for example, what can we say about real estate? Well, Real estate is a tangible asset, so we have something tangible there, right? It is something that at least hopefully produces some sort of output. We're going to talk about that in a second. And it is got some degree of maintenance associated with it, right? So this would be characteristics of real estate. It also tends to be a pretty local asset, and it tends to be one where you have the ability to negotiate on individual deals. It doesn't have any fungibility to it, okay? By contrast, we could go and look at bonds, right? Now, in general, I think it's worth understanding that within the class of products of loans, there are many types of loans. So the most common one would be government bonds, right? Government bonds are generally considered to be the lowest risk in the sense that they have the greatest chance or the least chance of losing money, right? But they usually also pay the least. And usually you'll have federal bonds, state bonds, municipal bonds, and then you can get into corporate bonds. You can get, high-rated corporate bonds, and you can get junk bonds. Then you can get private loans. There's secured loans and unsecured loans. There's all different types, right? Just like when it comes to real estate, you have, development projects, you have raw land that you're doing land banking, you have farmland, you have industrial, you have commercial, you have multifamily residential, you have residential, you have mixed use, etc., right? Then you can get into doing like the structure of how you do deals in real estate, right? Do you finance it, or do you do some creative financing? Do you do a lease to own, etc.? Those are all like complex things if you start going down the path of real estate, okay? Similarly, we can look at stocks and we can think of what are stocks? Stocks are really just you own a piece of a business, okay? So if you think, okay, I own a piece of a business, what is the deal with that business over time? Well, it could be a large public company, could be a small local business, could be anything in between, right? Could be a startup, so we have kind of venture capital, and even within there you have, is it an absolute pure startup, right? Something where you're putting in seed capital and it's got nothing going on, or is it a startup that's pretty fast moving and it's growing and it's got products and customers, etc. You've got some data, but it's not at the point where it's profitable yet, right? So you have this spectrum, and then you can get into industries in there and so on and so forth, right? You could also buy things like, lockers, right? You could rent out lockers, you could rent out bikes, you could rent out all different sorts of things, okay? The point is that there's different profiles. So what is the profile of a bond, for example, of a loan? Well, it has a fixed redemption value, okay? So whereas real estate has it's an unbounded upside in theory, right? Of course, in practice, there's obviously limits. It can't go to infinity or something, but there's no limit on the upside. Whereas on a bond, there's an absolute limit on the upside, at least kind of over a period of time, which is the redemption value. So in other words, I lend out $100,000, I'm going to be repaid $100,000 plus interest. So the best case scenario for me, if I hold to redemption, is that I get paid back plus interest. It's possible that the price of that bond could trade over time, and that somebody could think, oh, hey, I'd love to have this bond, and they're willing to pay you a premium for it in the short run. But there's a limitation on how much fluctuation that's going to have. So there you can go to zero. Technically, you could have some security or things like this, but in theory, you could go to zero. But on the other hand, it's generally going to have less fluctuation, okay? Then you have a stock. And a stock, what is it? It's more like real estate, right? Usually there's no tangible asset there, but what you have is you have hopefully some cash flow and hopefully some upside, but you've also got the potential for it to go to zero because it's not tangible, whereas say real estate is. Then you can look at something like a commodity where, okay, depending on the commodity, it could be very different, right? Soybeans are not going to be worth something in the future because they're going to go bad, they're going to decompose, etc. Gold, you're going to be able to hold it for a long period of time, but it's not going to produce anything. And this brings me to my first main insight for you, okay? Which is when we're investing, we have a desire to try and improve our returns, right? Which means, what does improving our returns mean? It means we're increasing the probability that we're going to have it be worth more in the future than it is today, and we're also trying to increase the amount that it is going to be worth in the future versus what it is worth today. Okay, that's our basic logic, right? So again, you can just kind of think like, okay, how would I do that? At the same time, we want to decrease our risk. Now, the way that governments and banks define risk is what's called beta, it's volatility. It's mostly nonsense. It's not really what you think of when you think of risk. So when we think of risk, what matters is what is the chance that I lose money and what is the amount of money that I would lose, the severity, right? So if I think about, for example, a vehicle, right? What's the chance on most vehicles that I'm going to lose money? I bought a vehicle, whatever it was, a couple months ago or something. What's the chance that over the period of time that I own that vehicle, that it will be worth less? Pretty high, right? I bought it knowing I'm probably going to lose, X thousands of dollars on it, but that's okay because that's the utility for me, right? By contrast, if you buy a house, what's the likelihood that it's going to be worth less in the future? Well, there's a chance, but probably not super huge. Okay. Now, one of the most obvious ways to help to reduce the risk and increase the chance that you're going to get a positive outcome is to buy something that has positive yield. Okay, it's a productive asset. So we want to separate productive assets from unproductive assets. Okay, what's the difference? Well, it's easiest to compare a piece of farmland with some gold. Okay, now some people might love gold. They might think that gold is the greatest thing, gold is the only real money and all sorts of this. I would generally caution you that gold is typically not a very good investment. Okay, although there's certain periods of time where gold might perform really well, generally you don't want to hold a lot of gold for a long period of time. If you're holding a substantial portion of your portfolio in gold, I would probably urge you to reallocate a bunch of that. There might be some specific reason for some specific narrow period of time where that makes sense, but aside from that, generally not advisable. And here's why. Let's say you go and buy $1 million of gold. Okay, you've got $1 million of gold there. You hold it for 100 years. At the end of 100 years, no matter what you did, what have you got? You've got the same amount of gold sitting there, right? That's it. By contrast, let's say you take $1 million, you buy a piece of farmland, right? You have a piece of farmland. At the end of 100 years, what have you got? Well, you still have the farmland, but you also have the crops that were produced from that farmland and what you were able to reinvest those crops into for that 100 years. So on average, over time, we should expect a productive asset to have lower risk and higher return than an unproductive asset. This does not mean that that's going to be what will happen, right? This is a probabilities game. It's not about something else. So for instance, Bitcoin is a fundamentally unproductive asset, okay? Most cryptocurrencies are an unproductive asset. However, because of the nature of Bitcoin and cryptocurrencies and kind of how they're emerging technology, et cetera, and the growing amount of use case, these sorts of things, the upside has been extraordinarily massive and probably will be massive over the next few years, right? Probably over the next decade, there's going to be a lot of growth in that space. There's going to be a lot of money made. And so even though it's unproductive, it may have a payoff, okay? Businesses can be productive or unproductive depending on whether they're profitable, right? That's basically, whether they're profitable or whether they're growing their balance sheet, essentially. Now, the balance sheet may be in intangibles, so that's a little bit more complex to figure out, but that's something, okay? So generally speaking, just think in terms of usually, if you're a total beginner, you don't really know, et cetera, err on the side of I want to buy things that are productive, meaning that I'm going to get something more back than I put in. There's some sort of a yield there. And this will happen with a good portion of assets. It won't happen with something like art. It won't happen typically with something like a vehicle. It will happen to some extent with a bond, right? Because you're getting interest paid. It will typically happen with something like real estate, but not if you're just doing land banking, not if you're necessarily doing development. So if you're doing those, I would say those are like on the riskier side because they could go the other way, okay? So that's the first thing. What is the second thing? The second thing that you can think about is what things are worth. So this is actually it's a super, super challenging question. What are things worth, right? However, if you can buy things for less than they're worth, then what is the chance that they will be worth more in the future than what you paid for them today? Probably relatively good, right? At the same time, if you buy something for more than it's worth, what's the likelihood that it's going to be worth less in the future than it is today? Higher on a relative basis, right? So part of a good investment is finding things that are underpriced versus what their fair market value is. So for example, I think I've mentioned in previous videos, the first house that I ever bought, I paid was $301,500 for it. And it was probably worth, it's always hard to say, but somewhere between $330 and $345, something in that range. So, I was walking into equity the moment that it was purchased, right? And that was good. It also turned out to be a productive asset. It could yield rent. It was, something that I was able to force appreciation on, etc. So this was another thing. So generally speaking, when you're going out there, what you should simply think is, okay, which things are productive, right? That's probably a good start for the majority of your money. I would say the majority of your money should probably be in productive assets if you don't know what you're doing in others. You might start to learn over time and think, hey, listen, I'm really good at this thing, and great, that's fantastic. But early on, it's wise to put your assets into productive. And why is that? Well, let's say that you're wrong about the price, right? Let's say that instead of buying that house for a discount, let's say I'd overpaid for it, right? So I thought that it was worth, $330, and it turned out it was worth $270, right? Well, if I'm making, let's say, $1,000 a month in rental income, then what do I have to do to get back to my baseline? I just have to wait. And this is a thing that I think is really important for people to consider, okay? Certain assets, time works for them. Certain assets, time works against them, okay? Now, does that mean you shouldn't buy things that time works against? No, absolutely not, because some things are gonna have a good little run and then they're gonna collapse, and that's fine. You can do really well on that good little run. But be aware, hey, there comes a point where time is working against things, okay? So you generally want to buy into things that time is working in favor of if you want to have kind of a set and forget mindset. So what are things, this is an example of the car versus the house, right? Or say a piece of farmland. Over time, that car, time is working against me on a car. Like I can actually go and buy a car, I've done this before, buying vehicles and reselling them fairly quickly for more than they're worth. In fact, I have a business, that's one of the things that we do. So we buy vehicles, then we sell them around the world for a differential. So you can do that, right? But the longer you hold that car, the greater the risk is that you're not going to recoup your original investment. Now, okay, there's some very rare collector cars where this will not be true, right? If you could buy like the original McLaren F1 or something, and have it in great condition, etc., okay, great, maybe then you're fine. Or some sort of other fancy collector's vehicle. But generally speaking, this is going to be the case. On the flip side, other things, generally speaking over time, are going to become more valuable. And part of the reason that they become more valuable is their utilization is going to increase over time, okay? So I'm gonna leave it at that for now because this is getting fairly long, but hopefully this was useful to you. If you liked it, mention it in the comments below and I'll do some more and make it kind of more comprehensive, and I'll go into each of these areas and describe, etc. But I think the first point is just understand there's a bunch of assets. You're trying to buy something that's going to be worth more in the future than it is in the present. You can choose from different profiles, like each of them behaves in different ways, and so you should think about that. If you want to decrease your risk, you should buy for less than it's worth. You should buy something that's productive, and ideally you buy something that time is working for you in kind of working on that regard. So I hope that helps. If you have any questions, put them in the comments below, and I'm going to look forward to seeing you guys on the next video.